As the U.S. markets are currently closed for the weekend, SoFi Technologies, traded on the Nasdaq under the ticker symbol SoFi, finished its most recent trading session on Friday, September 19th, 2025, closing at a price of $29.51. This represented a significant intraday gain of nearly 5%. Now, a move like that gets a lot of attention, but the real story isn't just the single-day pop. The expectation is that this surge is all about the consumer-facing app, the slick user interface, and the dream of becoming the all-in-one financial super app for millennials and Gen Z. The reality, however, is that the sophisticated capital flowing into the stock is likely focused on something far less glamorous, but infinitely more critical to its long-term valuation: the plumbing. While retail investors on platforms like the Robinhood app or SoFi's own SoFi Invest platform are buying into the growth story they can see and touch, a deeper look at institutional filings reveals a growing appreciation for SoFi's technology platform, the B2B segment that powers other banks and fintech companies. This is where the narrative splits, and understanding that division is the key to truly analyzing this company. The common belief is that SoFi's destiny is tied to its ability to acquire new members and cross-sell them products within its ecosystem, from personal loans and mortgages to online investing and insurance. This is the classic fintech growth model, a land and expand strategy built on user acquisition. And to be fair, SoFi has executed this well, consistently growing its member base. The expectation is that this flywheel, what the company calls its financial productivity loop, will inevitably lead to massive profits as acquisition costs fall and lifetime value soars. However, the reality of the current macroeconomic climate presents a serious challenge to this view. With interest rates in a state of flux, the lending portion of the business, which is still the primary revenue driver, faces significant headwinds. Loan demand can be volatile, and credit quality becomes a paramount concern in an uncertain economy. This is the risk that the market often overlooks in its excitement for user growth. The truth is, relying solely on the consumer-facing business is a high-stakes bet on a perfect economic environment, something no seasoned investor would ever do. Many who use Fidelity Investments or Interactive Brokers for their primary individual brokerage accounts are looking beyond the app to the core infrastructure. This is where we must shift our focus to the reality of SoFi's structure. The company is built on three pillars: lending, financial services, and the technology platform, which includes Galileo and Technesis. While lending gets the headlines, the technology platform is the quiet engine working in the background. Galileo provides the API-based backbone for many other financial companies to issue cards, process payments, and manage accounts. This is a business driven not by consumer sentiment, but by enterprise contracts. It generates consistent, high-margin, fee-based revenue. As more traditional banks and new fintechs seek to modernize their offerings without building everything from scratch, they turn to platforms like Galileo. This B2B segment is SoFi's hedge against the volatility of the consumer lending market. The recent stock movement, including that strong close on Friday, wasn't just a reaction to a market-wide upswing. It was underpinned by a growing institutional understanding that SoFi is quietly building a defensible moat in the financial infrastructure space, a far cry from the simple neobank label it's often given. The trading volumes on Friday were well above average, suggesting that larger players were taking positions, not just day traders. This kind of activity is often a precursor to a sustained reevaluation of a company's core value proposition. Delving into what SoFi actually does, it's crucial to appreciate this tripartite model. The lending segment is its legacy business, born from student loan refinancing and now expanded into personal loans and home mortgages. The financial services segment is the consumer-facing super app. This includes SoFi Invest for stock trading and self-investing, SoFi Money as a cash management account, and other services like crypto trading and insurance. This is the part of the business that competes directly with companies like Robinhood and the wealth management arms of giants like Fidelity. The goal here is to be the primary financial relationship for its members. The third segment, the technology platform, is the enterprise-level offering. By acquiring Galileo and later Technesis, SoFi gained the ability to offer core banking and card issuing services to other businesses. This diversification is what separates SoFi from many of its fintech peers. It's not just a direct-to-consumer play, it's also becoming an indispensable partner for the broader financial industry. This is the expectation versus reality dynamic in its purest form. The market expects a consumer story, but the deeper reality is a powerful and perhaps underappreciated B2B technology company. Looking toward the future, the outlook for SoFi stock involves weighing these distinct parts. The bull case scenario is that the synergy between the segments truly ignites. A strong consumer brand, financial services, draws in members who then take out high-margin loans, lending, and the profits from both are reinvested into making the back-end services, technology platform, even more dominant. The acquisition of a national bank charter was a critical step in this process, allowing SoFi to use its own member deposits to fund its loans, which significantly lowers its cost of capital and boosts net interest margin. If they can continue to execute on this integrated model while the B2B platform grows its enterprise client base, the potential for long-term sustainable growth is immense. This is the future that long-term investors are betting on when they open an account with Schwab Intelligent Portfolios or other online investment platforms and allocate a portion to high-growth tech. However, the risks are just as real. The bear case centers on intense competition and macroeconomic pressure. In the consumer space, SoFi is fighting a war on all fronts. It's competing with massive incumbent banks, established online brokerages like Fidelity and Interactive Brokers, and a horde of other fintech startups. At the same time, its lending business remains sensitive to Federal Reserve policy and the overall health of the consumer. A significant economic downturn could lead to a spike in loan defaults, which would have a serious impact on the bottom line. Furthermore, there is the risk of integration. Managing three distinct business lines is complex, and failing to create true synergy between them could result in a company that is just a collection of decent but not great businesses. The path to consistent GAAP profitability has been a key focus for analysts, and any stumbles on that front will be punished by the market. Now, I want to hear from you. Comment below with your biggest concern for SoFi over the next 12 months. Is it competition, credit risk, or something else entirely? In summary, the narrative surrounding SoFi Technologies is far more complex than the simple story of a disruptive banking app. The expectation is a straightforward consumer growth play, a bet on member acquisition and cross-selling. The reality is a much more nuanced company with a powerful and perhaps underappreciated B2B technology segment that provides a crucial layer of diversification and stability. The recent surge in SoFi stock to close the week at $29.51 reflects a market that is perhaps beginning to appreciate this dual identity. The path forward depends on management's ability to flawlessly execute its integrated strategy, leveraging the bank charter, growing its high-margin tech platform, and navigating a challenging economic landscape. Understanding the tension between the flashy consumer-facing app and the industrial-grade financial plumbing it's built upon is the only way to develop a truly informed perspective on this pivotal name in the fintech space.